So there's a number of factors. One, it focuses on a high-yielding sector of the fixed income market, which is not typically available to Australian investors. Over the years, it's provided a regular distribution stream, and it's targeting around 6% per year for that. It has a strong investment team and a lot of capable analysts located on the ground in the region. And it's also been tested through market cycles, in particular the Chinese stock market cycle. So over its existence, as an example, the fund has risks, and we highlight them in the report. But just to put that in a framework, over its lifetime, the Chinese stock market has had two major drawdowns, amongst others, of 31.5% and 12.5%. So significant moves in the equity markets, which we haven't seen in other markets. Over its life cycle to date, the fund's worst drawdowns have been 3.6% and 3.4%, which indicate that the risks have been relatively well managed to date. So since we started rating the fund 4 years ago, it's travelled a path from originally 3.75 stars to our most recent rating, which we issued in August, where we upgraded the fund from 4 stars to 4.25. Now 4.25 stars is labelled as superior, and it means that we believe the fund is suitable for inclusion in most APLs. The upgrade recognises that the fund has consistently delivered strong risk-adjusted returns over a long period of time. The risk processes of the fund have also withstood some particularly severe drawdowns in the Chinese stock market, for example. So the team is experienced, substantial in size, and located in the right places. Gordon Ip, who heads the process, is a very experienced and competent fixed income investor. He has a strong reputation across the Asian finance world, which is an advantage in getting deals done in the framework that they work in. Value Partners is a substantial firm in the Asian asset management space, one of the largest asset managers in the region, and it's been around for over a quarter of a century. So it has substantial resources that $18 billion of funds under management can bring to the fund in terms of leading edge systems and the ability to recruit high quality talent. So the numbers are larger than you might imagine. For example, recently the Asian Development Bank has stated that the bond markets in the emerging East Asia region amount to $15 trillion US dollars. Now China makes up over 11 trillion of that, and South Korea comes in second place at $2 trillion. So they're particularly significant size markets. So with the most recent data, we see that over 3 and 5 years, the fund has outperformed the RBA cash rate by a smidgen over 6.75% per annum. Since its inception, which is over 8 years ago now, it's delivered close to, actually exactly 7.89% per annum of outperformance relative to the cash rate. So the fund carries higher volatility and higher fees, and so we should recognise that in this framework. And what I can say is those numbers that I've just quoted you, relative to the fees that are charged, are 6 to 7 times greater, which is a very strong ratio. The other aspect is the fund does carry some high volatility, but those returns help offset it in a way that the risk-adjusted returns, such as Sharpe ratios, actually put it in the top quartile amongst its peer group. So given all of that, in my opinion, I think it has met both the formal and informal objectives set for it. So the fund is very much a bottom-up security selection process based on fundamental research. So the key to risk management is paying close attention to those fundamentals and to the credit risk of each individual security. So the key to that process is ongoing monitoring and close peer review, gathering as much market intelligence as possible, and the fund has been quite successful in that over its lifetime. So there's a few elements that are important. Firstly, emerging markets have a higher yield and have consistently done so over many decades, in fact. However, with that yield is also a fair bit of volatility, and that comes from a variety of sources, particularly geopolitical risks and economic risks, which need to be managed and thought about carefully. So, as a consequence of those different risks, there can be a lower correlation to some of the other asset classes, and that can be helpful. So when you wrap it up into an overall portfolio, it can be a good diversifying sector in an overall sense. And so in thinking about that, it might not be necessarily a large core holding, but certainly could play a useful role as a higher yielding satellite if it's managed properly within the confines of the overall portfolio risk parameters.